Hello, 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 everyone. I am Rosalind Brown of Your Wealth Guidance, where we help Black women create their financial independence map and identify the tools for success so you can live life on your own terms. Thank you for watching with us today. Be sure to hit the subscribe button and turn on notifications so you never miss one of our new great speakers. Today, we have a wonderful speaker, and so many of you all reached out and you were saying, I'm looking at these offer letters. Things are looking different, especially as you go up the spectrum in terms of income and you're trying to evaluate what makes sense. So today we have an amazing expert. We have Chelsea Ransom-Cooper. She is a certified financial planner who specializes in working with women founders and in the tech industry. Through Zenith Wealth Partners, Chelsea helps her clients through the many financial challenges they face as women with ambitious goals. Together, they work through equity compensation strategies, tax planning, investment and portfolio management, debt repayment, cash flow analysis, and so much more. As a managing partner of Zenith Wealth Partners, Chelsea and her team offer comprehensive financial planning for Gen X and Millennial clients. Together, they believe that financial planning professionals can work to help close the gender and racial gap, and they prioritize forward thinking and simplified strategies that make financial planning accessible to all. Thank you so much, Chelsea, for being with us today. It is definitely an honor. And I know this is a topic that's kind of near and dear to a number of people. And especially we have a number of people transitioning into tech. We know that's kind of the big industry to make big dollars. So tell us a little bit about kind of what we need to know.
Yeah. And you know what? I think this is like the key time because the point that you brought up is perfect that a lot of people have been transitioning to new jobs. And a lot of the jobs opportunities have been in the tech space. So traditionally, of course, we would get our salary, we would take out that calculator, we would divide it by 40 and figure out how much we would get in each paycheck. Now the compensation packages are a little bit different and we need to plan in a different fashion. Sometimes we have bonuses, sometimes there's commissions, but specifically what we're here to talk about is when that equity compensation package comes in. There's a lot of different terms that you may see: stock options, restricted stock units, employee stock purchase plans. There's a whole gamut, and it's really going to vary based on the company. But it's important to at least understand how you should think about it and what you should consider when you're reviewing offers to make sure that number one, you're getting the best opportunity. And then number two, making sure you're getting an opportunity that's in alignment with your goals for your financial future. So I'm excited to have this conversation today and just give you some key things that I like to point out when I'm looking at some of these offers or just helping some of my clients think about what they should discuss with their managers.
I love it.
Perfect. So actually, can I share my screen right now? Is that okay, Rosalind?
Yeah, you should
All
see the
right.
share button right there on the bottom.
Excellent. So
And definitely, if you all have questions too, you're probably getting some offer letters, or you're like, should I be negotiating something as it comes
yeah,
time to negotiate where my salary is today? Drop those questions in there as well. Maybe you were awarded some and you're like, I don't even know what I have or what that
yep.
means. You know, the first time I got restricted stock, I was like, thank you, but what does that mean?
Right. I think that's the hardest part is it's like, okay, this is great. Now what do I do with this? I actually was just connected with a new client who came on and she was so excited because she got an equity compensation package, only to realize that her compensation package in comparison to her previous employer wasn't that great. And she was frustrated, but we knew what to do to go into that next review cycle to at least make sure she was prepared. I want to just start off with specifically talking about the terms. Can you see my screen, Rosalind?
No, I can't, not yet.
No. Huh. To fix it, let me see. Mm-mm.
But I think that's a good point you make too, because I think sometimes if you're going from one industry to another,
Mm-hmm.
especially if you're going into the startup space or tech space or what have you, and people start throwing out these options, you start thinking, well, goodness, that's so great.
Yeah.
But if you're not sure how to evaluate that, then it might be a little bit of an issue just trying to figure out, does this make sense? Are the numbers as strong as they look like? Because sometimes they say you get 500 shares, and you're like, 500 shares? That sounds like a lot. And then
Right. And then you find out the strike price is a penny or it's 10 cents or something like that. And then it's like, oh, wait a minute now. Let me really reconsider this.
And I think that's part of it, is just trying to figure out, I got this offer. It sounds amazing. Is it really amazing? And especially if you're not that well versed in stocks overall, it might just be a harder conversation to go through. And especially to even have a conversation and negotiate with whoever is making that, or even if it's, your current employer and they're saying, hey, we're going to give you X. Then that's one of those things that might be, does this make sense for me also?
Yep. You know what? I think I finally figured out this Google Chrome. So I see the slides have made it up here, which is awesome. Some key things that I really want to make sure everyone knows is this is complicated stuff. Like, this is not something that you should feel bad about if you're struggling to understand it, or if this is the first time you've heard about it. Like, this is a pretty complicated compensation structure. And even though the terms are always the same, how a company can use them will constantly differ. So don't be hard on yourself if you are noticing some nuances or having some challenges. Today, we're just going to talk about those stock options, those RSUs, what taxes mean, and how you should think about this for your goals. So I really like to start with RSUs. They're kind of the simplest options that you have. And I know one of the questions that Rosalind, you mentioned to me was like, what is really the difference between a restricted stock unit and a stock option? A restricted stock unit is really nice because it's just given to you across a vesting schedule. And typically these vesting schedules are time-based. So as long as you stay there for, typically the vesting schedule is 4 years with a 1-year cliff, meaning for that first year, you don't get anything. And then after that, maybe you'll receive shares, whether it's on a monthly, quarterly, semi-annual, annual basis, whatever that structure looks like. And you'll receive that over that time horizon as long as you stay there. So assuming that nothing else changes, you continue to stay employed, you will continuously receive those shares across that vesting schedule. Sometimes what they'll also do is when you first get hired, they'll typically offer you the biggest package at that moment. So this is when we want to have a big ask. A lot of people will think that sometimes the equity compensation is fixed, and sometimes it is based on the role, but also understanding the type of company that you work for. Typically, if you think about like those later stage startup or earlier companies, cash is really vital to their business. So they're probably not going to want to negotiate on your salary or your bonus because cash is tight, but they might have a little bit more space for equity. So that may be an opportunity where you can ask for a bit more. Where if it's like a bigger publicly traded company, been around for years, they may have a bit more cash and may be more flexible on the cash side than the equity. So it's important to also understand what cycle the company is in, just so you're familiar with where they might be a bit more flexible. Restricted stock units are typically always offered in what's called later stage startups or publicly traded companies. And the reason for this is, number one, you're providing these across the vesting schedule, and you want to have the opportunity to buy and sell them as you see fit. Of course, there are these things that are called blackout dates. So there'll be specific dates when you can't sell them. So that's when they'll have their earnings report come out and they're specifically providing information to the market. But other than that, it's a really great opportunity for people in those later stage startups or publicly traded companies to be able to sell their shares if they want to for their own goals, or hold on to the shares as well. As I mentioned, there's two main actions with RSUs. So you really just need to continue to work there so your RSUs will vest. And then you have the opportunity to sell your shares. Those are kind of the two key main actions: vesting, waiting for vesting, and then potentially selling. And this is a busy slide, but honestly, this is a really helpful way that I kind of show clients how they can think about the trickle down of how RSUs work. So Rosalind, I know we talked about sometimes you'll get those RSUs, and then you, if you're granted, let's say 200 shares, like what does that actually look like? That 200 shares may not actually be what you see in your brokerage account or when it actually comes to you, specifically depending on number one, your vesting schedule and how long you stay there. If this person stays for the full 4 years, they'll get the 200 RSUs. But is that actually what's going to hit their brokerage account? No. And the reason for that is there's what's called net shares. So what they'll do is they'll typically sell shares to withhold taxes for you. This is helpful and you'll appreciate this, especially when you go to file your taxes, but they'll do it at a fixed rate, kind of similar to a bonus. Typically it's at the 22% tax rate, which may be enough, but depending on where your income is, it may not. So, and if you are in a higher tax bracket, you probably get surprised when you go to file your taxes and you're like, why do I still owe more money? And it's probably because of these RSUs where they did not withhold enough. I noticed this with a lot of my clients who are specifically in the 24 or 32% tax bracket. So they're just a little bit over, but that little bit makes a big difference when they're not withholding enough. When you're thinking about those RSUs, so for example, this person got 50 on January 2021. So their net vest, so the amount that they actually received to their brokerage account is 32 shares, because technically 18 shares were sold to withhold for taxes. So really, when we look at it, these net vest is what you actually have the choice of, do you want to sell it or do you want to hold on to it for that long-term growth? So that's something to consider. We're talking about it from a shares perspective because I think it's simpler, but you'd also need to multiply that by the price that it's currently trading at to get a clear understanding of how it's actually performing. Now, keep in mind, when we're dealing with the stock market, these numbers are not fixed. The share number may be fixed, but what it's actually worth is going to vary. I've had clients who had RSUs in year one, and maybe they received all of these and the shares were trading at $200. And then by year three, they're trading at $30 a share. It can be a very humbling experience sometimes. So it's helpful to make sure that at least you have a clear end goal, regardless of what the market does. This is what I'm planning to do with my RSUs. I'm making sure I'm covered from a tax perspective first. And then any decision after that should really be focused and emphasized on your goals. Keep in mind down here that taxes are due every time they vest and every time you sell. So that's something important to keep in mind. The only way that you would not have to pay taxes on the sale is if they're trading at a loss. So then you could take what's called a capital loss, but I'll get into that later in a second. And then we have our good friend stock options. These are a bit more complicated than RSUs. You have to do a little bit more. But the key term is the term option, right? It means you have the right, but you're not required to buy a specific number of shares as they vest at a preset price. So the nice thing is you always know what you're going to have to pay. But the key is that the tax implications will be different. There's what's called incentive stock options, where I like to call these you are the master of your fate stock options, where you kind of can be strategic and make sure that you're minimizing your tax implications from these. I'll talk a little bit about how later. And then non-qualified stock options, where you pretty much have to pay ordinary income tax as soon as you buy them and when you sell them. So these are a lot less advantageous when it comes from a tax perspective, but depending on how they're trading, it can be helpful. There's going to be some key terms that we need to know when we talk about stock options, though. So we have that strike price, which Rosalind, I know we were talking about, where we were saying somebody could get 500 shares and maybe they're trading at a penny, which is great if they're at the strike price of a penny, but the fair market value is $1, right? That's a nice appreciation right there. But I think the challenge is stock options also are typically offered in companies that are not public yet. So you don't always really know what the valuation is. It's not like you can just go on Google Finance or Market Watch or any of those and just see, okay, what is the latest valuation? Sometimes a company may only come out with the latest numbers once a year or twice a year. So it makes it pretty tricky to plan. And it's important to know what your goals are in that capacity. So we still have that vesting schedule. We still have that cliff. The key difference here, like I said, is you're going to get that strike price, which is the price you pay per share of your stock. And then depending on the date that you exercise them, that's what will be your exercise date. And then, of course, when you sell. With these, we have three options. Remember, our RSUs, we had you can invest and sell. Now we're adding a third component in here, where you do your best work, you vest your options, and then you have the opportunity to exercise your options, so buying into the company, and then of course you have the opportunity to sell. This exercise component can make it a little bit tricky, because you do need to make sure that you have enough cash saved to buy the shares of your company. That's a really important part that you need to remember, is that you do have to buy in, and depending on what the exercise price is, it may not be affordable to purchase all of them, or and honestly, it may not be prudent, right? Especially if you have credit cards, if you have high interest student loans, if you don't have your emergency savings, or if you just have big things coming up in your life, maybe now is not the best time to exercise. The great thing is, typically with stock options, you get 10 years from when your stock options are granted to you to exercise. So you don't always have to buy them as soon as they vest. You can come up with a strategy that really works best for you and your financial goals, if you do think there's some growth opportunity for your stock options. I'll pause there, Rosalind. I know I just said a ton, but I think that should give us like a clear understanding of like what these terms are, before we really get into what it specifically looks like and how we can even maneuver with some of these vehicles.
I think one question would be, especially on the option side, so they have that time period, but
Mhm.
especially, over the last years, we've seen the market go up, up, and up. When do you know it's time? So
Right,
do you keep holding out and saying, wait, it's going to get better?
right.
It's going to get better. How do you know or calculate that kind of optimal time?
Great question. So I specifically, when I look at the stock options, you want to make sure there's a term, it's called like in the money. So what that means is, and I'll use our penny example because I like it the best. You always want to make sure that when you're exercising your stock options, the purpose of stock options is that you're getting a discount, right? So a perfect example is our penny. You get this strike price, or that's the price you would pay per share. And then the current fair market value is 2 cents. So really you made that spread is 1 cent. So if you buy it at a penny, you've already bought it at a discount and you're not paying the same price that other people are paying. You always want that fair market value to be higher to make sure that you're getting a discount. I would never want to buy if this was 2 cents and this one was 1 cent, if it was inverted, right? Because that means I'm paying more than everyone else is paying. That doesn't make sense. Specifically right now, especially for my clients who work at some big companies that unfortunately have really, really been humbled. I think that's a nice way to put it. They are underwater on their stock options. A perfect example is one I know her strike price was $33. So this exercise price is $33. The current fair market value of her shares is $9. It makes absolutely no sense for her to buy those shares at $33 when they're trading on the public market at $9. So first and foremost, you want to make sure that you're getting the true discount that it's supposed to be, the value add. Um, that's the first part. The second part is, especially when you're looking to exercise your stock options, I think you need to also have an honest conversation with, you are kind of buying a piece of paper, right? And you're hoping that someday somebody tells you that piece of paper is worth something. So I think you also need to be fully aware that it could never be worth anything, especially when we're thinking about stock options. So as you're considering how much you want to exercise, if you're unfamiliar if they're going to go public soon, or if there's a probability of any liquidity event, I always ask my clients, like, are you comfortable if this goes away? And if not, and if you need it, then now is not the time. Now is not the time, and we should probably hold off. But if you're okay with it and it wouldn't be detrimental to your financial plan, or if you have a high risk tolerance and you say, you know what, I just want to try and I want to be involved, or you're really optimistic on the company's growth, it could make sense to buy in. Of course, assuming that it's still trading at that discount and that price is still at an advantageous point for you.
And I know you mentioned, especially a number of these companies are not public traded. So
Yes.
they're not publicly traded. How often can you buy, sell, and how do you get that information in terms of valuation?
Great question. So a lot of them will use platforms like Carta, or there's quite a few. Carta and there's one other, but anywho, they typically have to provide that information. It's what's called the latest 409A or fair market value valuation that they provided to the IRS when they file their taxes, they have to legally provide that to all of their employees every time they update it. Now, granted, again, this is typically provided when you file your taxes. So some companies will only provide it once a year. Some companies, if they're fundraising quite often throughout the year, they'll update it more frequently. So you'll be able to get that information updated in Carta. But also, I think this is kind of the value add of working with a financial professional that understands this. So specifically with my clients, I look at the latest growth rate, and then we'll take a look and say, okay, based on this, where do we think this could be, with a baseline assumption of whatever the rate of return has been for the past 3 years, for the next 3 years, and then see if we're comfortable with that. I also say, if you're working in a company, you know it better than me. You're in there day in and day out. So I can just tell you what I'm seeing and what the market perception is for this company, but I don't really know. So this is where, like, you really are, you have an advantage point as an employee. And I have to say, if you're going to work there, number one, you already have one part, you have your income tied to this company, which is a big part of your financial plan. If you feel comfortable adding other parts like equity compensation, then you must be confident in the growth, and you must not want to kind of shift your career strategy. So I think those are two kind of big points that I consider when we're trying to determine what makes sense.
Now, I know, depends on how old you are on this call. I think the big company or the big news headline that most of us are familiar with when it comes to company stock is Enron. So
Yep.
when you started your career. And so when you're talking about this as a part of your compensation, when you're talking about adding this as a part of your portfolio, how do you know when to say, okay, wait, that's too much. I don't need all of this company stock. I work here. I like these people. I don't know if this is going to be around forever. I don't know if this is growing at the rate that I think it should. Those kind of things. How do you know that?
Yeah, and I think that's, you have to understand, though, diversification is a really great way to minimize your risk by spreading out your investments. I mean, I think we all look at Enron as kind of like the worst case scenario, and then Jeff Bezos as the best case scenario. But there's a big gap between those two. And the probability that we will all be the next Jeff Bezos is pretty slim. So we do have to do some risk mitigation strategies to make sure that we're not hindering our growth. Especially like when I look at these individual names, and some of these, I'm sure you're familiar with, Rosalind, where you saw that they went public in 2019 and 2020. Like, what goes up can always go down, right? And when you're looking at your own finances, like I always say, if you have a company stock, what you can do is you can see like the 52-week high and the 52-week low of where it's trading, and just look and imagine if all of that money you had went down, how would you feel? And I understand there are some high risk traders who are like, Chelsea, I would buy more, I'd be fine. But I know a lot of people that if they know they have 30, 40, 50,000, which is usually the size of some of these equity compensation packages, all drop 25 to 50%. It's not a great feeling. It's not a great feeling to see, no matter what. So there is a way where you want to at least try to diversify and make sure you're not putting too much in. I say the kind of the financial planning profession says, like, a rule of thumb is to try and maintain around under 10% of your portfolio in one specific position or security. Now, I say rule of thumb, take it with a grain of salt, because it's going to vary for all of us. But if you're looking at your portfolio and you see that your company stock is over 50% of your overall investment portfolio, that is very concerning. And I think that should be a kind of an opportunity for you to kind of revisit and see, okay, how can I minimize my risk? Because when it goes up, I'm going to feel like a genius. And when it goes down, I'm going to be ready to fight the world.
And that's a good point, even in terms of the difference between restricted stock versus the options, because of course, on the option side, it may be zero. It's never a good time to actually exercise your options.
Right.
So if somebody is choosing, should they choose or push towards the restricted stock portion? I mean, that can be up or down as well. Is there one way that people should say, if I have a choice, should I ask for this versus that?
Yeah. So if you have a choice in a few companies, if you get in like when they're still pretty late stage, you might be in the position where you have a choice. If you get on pretty early, I'm very confident that it'll only be stock options. If you get in very late, it'll only be RSUs. But if you can catch a company in the middle, they may present an option to you, or do you want 100% of one or 100% of the other, or maybe a combination of the two, right? And I think that's where it really gets tricky for individuals, where they're like, all right, I've just learned what these terms mean. Now, how am I supposed to make the decision of what really makes the most sense for me? And this is where it goes back into those goals again, where I like to treat restricted stock units as treat them as a cash bonus, but just pretend, well, not really pretend, but acknowledge that your company doesn't have the cash to pay you. So they're just giving you the stock instead. So you have the choice to sell it and treat it as a cash bonus that it is, or you can hold on to it if you don't need the cash and let it appreciate, hopefully in your favor. So that gives you that flexibility, which is really nice. Where stock options are really where you're trying to get that long-term growth potential, right? As we talked about, if you get in at a penny and it's trading at $1, I have a client who has stock options at 350 and they're trading right now at $12 a share, right?
Nice.
Which is an amazing opportunity. So they want to buy and hold, knowing that if it's already at $12 now, who knows where it could be when they go public, right? It could potentially be significantly higher. So those are opportunities where they are familiar that they want to do that long-term hold, and they're okay that they could see that up and down. But with their restricted stock units, we're leaning on more of a strategy just to buy and sell them. And that's what they're using to pay for their extra money for the kids' summer camp, or if they want to get that new car next year, or if they want to get some more money to put towards that down payment, because housing prices keep going up, so they can't catch a break. That's when they can really lean on those RSUs, where it provides a bit more flexibility and also more stability in a planning perspective. Because in publicly traded companies, usually, I can't say always, but usually you see a bit more stability and kind of market volatility, especially in those larger companies like the Googles, the Amazons of the world, than you would in some of those smaller companies that recently went public, or those later stage companies where they're just going to experience a lot of volatility because they're still trying to prove to investors their growth plan. Long story short, RSUs, if you want that cash bonus, if you want to have a bit more consistency and reliability in your financial plan, that's where I would lean more on those. If you're comfortable taking on risk, if you're thinking about the long term, you don't have cash needs right now, and you want to maximize your growth and you have that high risk tolerance, lean on those stock options.
Now, you made a great point, especially for the person where their company says, hey, you can buy this stock today at $3 and it's trading at $12. So they buy one share today, they can make $9.
Right.
So is there ever a limit where you can't just buy them all and then sell them all the next day? Is there ever any restrictions there?
Yes. So if your company went public, for example, most companies will have a lockup period. So let's say if I took a company public today on July 11th, typically what they'll do is for 6 months, any employees cannot buy or will buy, yes, but they cannot sell specifically, because they want to try and focus the market on what's public information and not what the employees are feeling as well. So specifically, so for those 6 months, I can't do anything. Then they're going to have what's called blackout dates. And blackout dates will be when you can't buy or sell, specifically when the earnings are coming out, quarterly earnings. So there's going to be small windows of maybe 1 to 2 weeks for that first year where you actually can buy and sell. So it's just going to be a little bit trickier to plan because you'll have to move a lot faster. Where if we're looking at these bigger or larger, more traditional companies, you don't have to worry about that because they've been public for so long.
That's good to know. So it may be some great opportunities. Sometimes you're like, oh, I could make some quick money.
Yeah.
But what about taxes? I think that's a big one too.
Oh, the taxes. Oh, goodness. Well, that's the most frustrating part. So like specifically with the taxes, and I wish you could say like, oh, you don't have to worry about anything, but this is the the frustrating part about stock options are not only do you have to buy in, but exercising and doing that purchase can actually create a taxable event depending on what type of stock options that you have. As I mentioned, those non-qualified stock options, those, whatever that spread is, so here it's a penny because I like simple math. But for that client that I talked about with a 350 strike price and the $12 fair market value, that spread of roughly what 850 is added on as regular income tax, and it's taxed the same way as their paycheck. So if they buy one share, cool, what 850, but now what if they're buying 500, 600 shares? Because especially with stock options, you'll usually get more than what you would receive with RSUs, because you're really buying into the growth strategy and plan that they have. So sometimes you can see stock grants of 10, 20, 30,000, which is excellent. But also just keep in mind, you have to buy all that. You do have to buy all that. With incentive stock options, there is not any tax due at the exercise, but you could potentially be subject to what's called the alternative minimum tax, which truthfully is a pretty annoying tax where it's a parallel tax to your regular income tax. And they pretty much, they add back certain deductions. And then also for incentive stock options, they add that spread. And if the alternative minimum tax is higher than your regular income tax, they add it on top, which is just frustrating. So a lot, especially with incentive stock options, a lot of my clients, what we'll do is we'll run an analysis to see how much they can exercise before it would trigger the alternative minimum tax. And we only exercise that much each year. So at least they only have to worry about buying the stock options. They don't have to worry about also paying the tax on top of it. Or if non-qualified stock options, you have to pay for the shares, and then the taxes are due when you exercise them as well. And then of course, when you sell them, well, now it's the same thing as if you did any buying or selling of Robinhood or any other brokerage account. So that new, when you purchase them, that fair market value is your new cost basis for your new starting point. And then whenever you decide to sell, it's that sale price minus the fair market value when you exercise them. And that's treated as either a short-term capital gain if you sell it in less than 12 months, or it's treated as a long-term capital gain if you sell it more than 12 months from exercise. So there's a lot of dates that you need to stay on top of to see what your strategy is. The annoying thing with incentive stock options is it's what's called a qualifying disposition. So again, since these are the more advantageous ones from a tax perspective, the IRS said, well, we're going to kind of make this a little bit more complicated. So if you sell less than 2 years from when they were granted to you, and less than 1 year from when you exercise, now we're just going to treat them as non-qualified stock options, and all of the preferences that came with it before go away. And now it's just going to be taxed the same way your paycheck is, which can be really frustrating if you're not paying attention to these dates and you weren't prepared for that. So honestly, if you have incentive stock options, if you think you're thinking about exercising or selling or coming up with a strategy, it's important to at least talk to a tax professional or a financial professional just to make sure that you're not losing any of the potential gains or the proceeds that you're planning to get to taxes.
Oh, that could be a big hit. That could be a real big difference, especially if you're so close to the year mark.
Exactly.
How can I hold out?
Exactly. And that 15% is very different than if you're in that 32% tax bracket for your income. That can hurt.
Now, one thing, this was a good question in terms of what happens if your company goes bankrupt?
Ooh. Remember when I said that piece of paper could be worth nothing? Yes. So depending on the structure of your equity compensation, as for the most part, it's treated as either common stock or preferred stock. If it is treated as preferred stock, it just means that if there is any money to get paid back, you get it first out of all the other investors. But again, with the assumption that there's anything else paid back. For the most part, people are paying down, they're paying back debts, They're paying off payrolls. They've got a million other people to pay before they pay you. So, yeah, that's part of investing, though. That's part of investing, and that's a concern of being invested in a single security, because that could be that could occur. But if you're invested in a diversified portfolio of ETFs or multiple securities, you're able to minimize that risk of bankruptcy or not being able to meet their investor needs or pay out dividends or reach growth potential, because you're spread out across 10 to 500 different stocks now. And the probability of all 500 stocks in the S&P 500 truly going bankrupt, I mean, we would be in dark days, like the medieval days, if that happened. There would be fires in the street. It would be really bad. It would be really bad. I promise you will not care about your portfolio.
When you wish you had some canned goods stocked away in the cabinet.
Exactly. So all that to say, that is part of investing, and that is a risk as well that you just have to be comfortable with, which is also to the point you brought up earlier, Rosalind, is making sure you're not being too aggressive or overly aggressive, because like I said, if that piece of paper goes away, you need to be prepared for that.
So definitely, I guess you wouldn't want to take a loan to exercise these options or anything like that, or borrow from your 401k to exercise the options.
Oof, that was actually something that was really popular in 2020, where I know quite a few people that did that. And I can confidently say they are not happy with that decision. It's been really tough, especially because valuations and companies were trading so high and everyone was so excited. They were like, everyone's going public. Everything is going up. Like, come on in, the water is great. You can't lose. And then, we're seeing recessionary activity, and we're seeing valuations come down, and we're seeing people getting laid off. And now the question is, all right, actually, maybe that wasn't sustainable like we thought it was. I think the biggest one is Klarna recently, where their valuation came down. I think they were around like 50, 60 billion, and now they're down to 5.6. Like, their valuation it humbled them very quickly. But also, like, I think about their employees, right, who exercised at that higher valuation, and now it's down here, and now they're underwater on their stock options, and all they can do is wait. Especially if they already purchased them, all they can do is wait and hope that it goes back up.
Oh, that's definitely a scary kind of thought overall, because I definitely know that when the market is up, people are very confident, and we've had some very great years.
Yeah.
And unfortunately, no one has the good crystal ball in terms of things shift, but they are called market cycles for a reason.
They are.
If you're seeing these and you're like, maybe I will, this sounds like a great opportunity, who should you have on your team? I know you mentioned a tax professional, but like, who should you say, hey, before I go ahead and make this move and throw this money on the table, who do I need to talk to and bring into the room?
Yeah, so you absolutely want to make sure you have a CPA, tax professional, or having a financial planner who's a tax strategist. I'm not a CPA or anything in that regard, but I do work closely with my client's CPA, and we do tax strategies and planning, and we'll run out projections for the full 4 years of their vesting, and we'll talk about the potential upside or the downside and their concentration and their diversification. You just want to make sure you have somebody who's familiar with these topics. The same way every financial advisor, you can't go to a doctor for everything, right? You just can't, just because they have the DR next to their name doesn't mean that they can help you with everything. The same thing with financial professionals. There's experts in retirement planning, insurance planning, people who work with millennials, people who work with high net worth individuals. You just want to make sure you can talk to somebody who truly does understand the nuances of either your specific equity compensation package. So maybe they've worked with quite a few of the other employees at your company, or they're just familiar with the terms and the strategies that would be best for you, to make sure that you're really getting the best options that are available, and you're focused on the key considerations that are important for your goals.
I think that's a really big thing, is in terms of just creating the team, and especially the first time you see them.
Yeah.
I think you talked about there are startups, there's tech companies, and all that in terms of when you should expect it. But definitely, are there other industries? Because I'm gonna say when I got my first stock, when I got my first restricted stock, I was 20, 22 years old, something like that. And so I'm
Yeah.
like, I don't know what this is. But I think one of the bigger things is just one understanding that they exist. So maybe if they don't bring them up to you, is it a certain type of company that you should bring it up to them? So if they say, "Oh wait, we can only go up to this salary," should you say, "Well, could you provide me some stock options?"
Yeah. So if they don't offer stock options from the jump, they probably don't have it. I would say for the companies I've worked with, if they offer it from the top to the bottom. And it's not even just tech companies anymore. It's medical companies, industrials, like consumer discretionary. Honestly, at this point, I'm like, as a financial or tax professional, if you're not familiar with these terms, you're probably doing somebody a disservice because it's starting to infiltrate every aspect of compensation strategies. I know we talked about financial services and tech as the big ones, but it's really rolling through everything now. When you're thinking about your options in your offer, I would say first and foremost, like understanding the companies that you're applying for. I always like looking at Glassdoor, or there's like some other opportunities to connect with individuals to see what the package looks like. So at least you know what it's probably going to have. So you should at least know, okay, there's probably going to be some RSUs, there's going to be a salary, there's going to be a bonus component, whatever it is, and then understand what you need to reach your financial goals. So if you know you need X amount of dollars on a monthly basis and that's a non-negotiable for you, then you probably want to go a bit harder on the salary because cash is really going to be important for you, at least in the near term. And we don't want to minimize that just for potentially making money in 10 years, right, off of stock options. That cost benefit doesn't make sense. But if you are in a place where you're pretty comfortable and you know that even if you did get a lower salary, it would not be a significant shift in your lifestyle. It would not reduce your goals. It would not impact your savings or anything else you're doing. Then you should feel confident having that conversation and seeing what opportunities are available for those stock options or those RSUs. But like I said, it's also really important to understand the type of company and where they are in their business cycle. Like going to a company, a early stage company, and asking for more salary kind of doesn't make any sense. They're balling on a budget. Where on the other side, like going to a company where if they're really big and they have a very formal like structured RSU plan, like by for each of the 80 different roles they have, right? You probably will have more success talking about that bonus and that salary because they have a lot of cash on their balance sheet. So it's just important to know the type of company you're talking to also, which can help you negotiate and be strategic. Um, but also kind of go in there and know what your highs and lows are, right? Like, what is that number? That number where you're like, I know I will not get out of the bed. Like, this is not the number I will even consider leaving my job for. And I always like to say to my clients, whatever that number is for you, like keep that in mind. Don't tell anyone that number. Do not tell anyone.
Don't share
You
that.
won't get that number if you tell somebody that number. And then think about the number that you really want and that would make you feel comfortable, and then add 10,000 to it. Always. That's always my rule. I'm like, whatever that number is that you feel comfortable, add $10,000 to it. Because I've very rarely seen a company meet somebody exactly what they asked for. There's always going to be a negotiation, it's always going to be a dance. So at least just make sure you're taking care of yourself and always go 10K over whatever you really want. And you might actually either you'll get it, which will be fantastic, or they'll come down and meet you where you want it anyway.
I think that's a great part of just salary negotiations, period. But definitely knowing these other components. I think when you first start working, I know my first job, I was like, this is how much I make per hour, and I'm trying to make 50 cents or a dollar more. And
Yeah.
then all of a sudden you get to the point where it's salary and you're like, oh, salary nice. Oh, bonus, nice. And no,
Mhm.
this thing called restrict. Okay, that's nice too. Now one question, I know 100% of people when they hear like the Jeff Bezos story, when they hear about like the team over at Google, or they hear the
Yep.
Facebook story. They're like, I would never sell.
Right. I would have held forever. Yep.
I would sell that forever, and I would be
Mhm.
rich just like those people. And they talk about the 2 or 3 people who sold. They're
Yep.
like, they're so dumb. Now,
Yeah.
how do you know if this is a Google, if this is an Amazon versus some company I can't name because I don't even remember, and they
Yeah.
never lasted enough to make an impression? How do
Right.
you know which one you're holding?
Yeah. And that's the hard part. You don't know. I promise if I had a crystal ball, I would be in Barbados right now. If we could truly like tell, and I could just look at a company and be like, that's the next Amazon, that's the next Google. I promise you, I would be on an island. But that's the hard thing is you really, what all you can do is you can look at the numbers and you can make objective decisions. I think it can be really hard though, because it is your money. Like I'm a financial planner who is working with a financial planner, right? Because of that reason, even though I am familiar with the terms and the numbers, like there is still that emotional component where it doesn't feel good if you start to see, or if you start to have concerns, or you start to see things go down, you start to question your decisions. So it's nice to have that objective position, but also really let your goals define you. So if we're looking at you need $50,000 for a down payment, when that hits that $50,000, you take your winnings and you go. You don't get greedy and say, well, what if it hits 100? Because what if it hits 25? And now you're upset because now you need to save even more to hit that goal. So I think it's really important to let your goals determine when you're going to sell and just keep that as your North Star, and you won't feel like your regret because you got that house you wanted, you got that car, you put your kids through college, you did what you wanted to do, right? It's not like you were ever put in a position where you couldn't succeed. Could you have made a little bit more? Of course. But you know what? That greed can sometimes really eat into those goals. And I think you would feel a lot worse if you weren't able to do those things. So just trying to not stay greedy, I'd say.
I think that's a really good point, especially where we saw the market just a few months ago, comparing to where we are today. Most people were like, no, 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 I'm not ready to sell yet. I'm not ready to sell yet. And then all of a sudden,
Mhm.
like, dang, should have sold.
Literally, I could not get a single client to sell last year. It was like they were like, no, I don't want to. Now this year they're like, oh, I want to sell everything. I'm like, I bet you do. I bet. But that's the hard part, right? Is like hindsight is always 2020. It's always so clear to point back and say, oh, you should have done this when you were in that same position. So, but that kind of goes to the point also that these personal finance decisions, these equity decisions, they're so personal. Like they're not cookie cutter, they're not one size fits all. You really just need to make sure you're making the best decision for you and your family. And if you need to have a conversation with somebody just to kind of talk through it and see if it makes sense, it can be helpful to get that third party opinion. But otherwise, yeah, I know very few. No, well, I have quite a few clients who wish they would have sold last year. But the ones that sold and met their goals, they don't come back and they don't say, "Oh, I wish I would have held," or "Oh, I wish I would have done this," because they got what they wanted.
I think that's a really big point to kind of make and make sure that people remember. I always say, even if you live through another market downturn, you're like, oh, wait, I don't forget. This one is different. This one, you still got a little more time. This one is
Yeah.
definitely different. So I think that's a really big thing to kind of think of overall in terms of, huh, what do I, what do I do? Do I hold out just a little while longer and make, gobs of money, or do I just take this little bit of what I actually need at the moment? And that's a hard decision to make because it's so emotional. You're like, everything.
Mhm.
It's like being at the casino and you're like, put it all on black.
Literally. And honestly, when people do that, I'm like, this is when it kind of feels like gambling a little bit, when you're just kind of making sporadic decisions like this, right? And it's just like, all right, swipe it, put it on, like you said, put black 22, red, like, and just throw it all on there. But also, like, when you look at some of these companies, I think it's hard, like the big ones, like the Googles, the Amazons, the Microsofts that went up for so long, and it felt great. But now you're seeing kind of this adjustment. Like, You just have to be prepared, but also it can really be helpful when you're negotiating like new offers to remember what you're leaving on the table and bring that up in the conversation to make sure that you're getting the best deal at your next place. So if you have shares that are unvested, that you have to leave on the table because you're leaving, especially if they're RSUs or stock options, absolutely bring that in the conversation for your next offer, saying like, hey, listen, this is the range I'm looking for, but also I wanted to let you know whatever perks or bells and whistles they had at that place with unlimited vacation, flexibility in hours for your family, shares, options that didn't vest that you're leaving on the table. Bring that up, and you'd be surprised how companies are familiar with it and will try to at least meet you with what you're leaving.
I think that's a really good point, is to remember what you're leaving on the table, because you may have said, actually, those options suck. I'm about to leave.
Yeah.
But if you're 2 years in and you had 5, 6, 7 more years, who knows what the potential could be there.
Yeah.
Now,
Exactly.
another question in terms of, you're working at this company, you
Mhm.
have the company stock, it's a smaller company, so you might sit right next to the boss, or
Yeah.
hear people on the phone. Now, is there ever an issue of insider trading where some non-public information because you heard them talking in the other room, or you work late and they didn't know you were still there? Are
Mhm.
there ever any issues there? Because you like, hold on, they just said, wait, what?
Yeah.
Let me buy
So,
some, or let me sell some, or whatever that might be, because you
mhm.
heard something. Everybody's like this open office concept or whatever, and you're like, hmm,
Yeah.
good
So
information.
no, and that definitely is. So for smaller companies, it's not as big of a concern, um, because, like I said, they're only offering that valuation like once a year. So, like if you think about it in comparison, the public market changes from 9:30 to 4 every Monday through Friday, except federal holidays. But if you're in a private company, you're only getting that update once a year. Now they could talk about, oh, they're doing all this fundraising and stuff and things like that, but it's actually not going to impact your shares until they make that formal update. So it's just a lot slower. And then also in private companies, you can only sell if there's a liquidity event, if there's a merger or acquisition, or if they go public through like an IPO, a direct listing, a SPAC, or if they sell shares on a secondary offering. Other than that, you can't sell. So even though you may know some information and you're like, ooh, now's a good time to buy, especially if it's a private company, you probably can't sell anyway. So you're still sitting on that hope and prayer. And if it's on that company that went public recently, well, you have blackout dates that are typically 2 to 3 weeks per quarter are the only times you can buy or sell. So they come up with ways around it to kind of restrict that. Also, if you're an executive at companies, that's why they typically lean on, they're called these a B51, 8B51 plans, excuse me, for executives. So what they'll do is you actually have to write on a piece of paper when you're going to sell all of your options for the year in advance to minimize that risk of having that structure. Excuse me, being called out for insider trading, because then you say, nope, nope, I submitted all of my buys and sells for the year in January. And I worked with my financial planner. We helped to decide how much I would need to reach all my goals. And I submitted it. And then the back office automatically does it based on the dates. So you can't say anything. Like, it's not like, oh, you just did it because of this news came out. And it's like, nope. That's one way that a lot of big executives minimize their risk. Pretty much all of them honestly do that. And then employees, like I said, just kind of go through the traditional blackout dates.
That's okay. So don't think y'all listening at somebody's door, or
It's okay. It's okay.
they didn't lock it or something like that, and think you're getting some additional information to figure out when's the best time to exercise your
Yeah, that's okay because you're an employee. Now just don't go on social media and trying to tell everybody all this stuff. Then you're gonna get in trouble. But if it's just for you, you're an employee there, it's honestly expected. Like it's okay. Just like I said, don't go out and tell everybody. Then you're gonna run into trouble for
don't
sure.
tell your mama to buy them in her name.
Exactly, exactly, exactly. But I think, and what's really great about the group that you have, Rosalind, and I always encourage our clients to do this as well, is like talk to each other. Like, you would be surprised how many of you are in like similar roles, maybe just in different industries, and just have conversations about what you're seeing. It's been so helpful to know, okay, somebody's a product manager at Google, and I know someone at Facebook, and I know you're getting this, and then this one at Amazon is getting this. So like, how do we make sure like you all should kind of be getting the same? So you need to ask for more here or there. Having those conversations and like having that central kind of salary database or anything like that can be really, really helpful. I know that's something I do for my clients, where they'll always ask me, they're like, do you have any other clients who have this role or work at this company, and what can I expect? And then I can just kind of go through and I'm like, hey, yeah, I had about 3 or 4 clients. This was the range that they got. And this is where we noticed they were a bit more flexible on this side. So when you're having the conversation, bring this up. It's been really helpful to make sure that they're not leaving anything on the table also.
I think that's a really good point, just overall, is having that conversation about where your income is, what matters, what you should be negotiating. Because as women, I mean, traditionally, we're already underpaid, and we know that. But if you're sharing that information among friends, and you can say, hey, girl, you should be asking for more, or I know somebody who does that over here, let me connect you with that person. I think it's just imperative of something that we continue to do, because it just helps us in the negotiation overall. Like, there's no way that we even know sometimes, especially as we're moving up the income ladder and we're getting to that next point. I know way back in the day, it was like everybody wanted to make 6 figures, but now, I mean, people are like, no, 50, 300, 500. And if you are there and you're at that point where they're giving you things that you didn't even know existed, you're like, I don't need a 401k plan. And they're like, do you want to go in the non-qual plan too? And you're like, wait, what?
Right. Exactly. Exactly. That's so why you got to look at all those benefits. Go through that benefits package with a fine tooth comb when you get that offer, because that's also another place where you can ask for some stuff too.
And I think that's a big thing, is just kind of knowing that. But I don't think as many people, when you're getting your offer, you don't immediately think, you might call, you call your girlfriend, you call your boyfriend, you call, your best friend or your mama, and you say, mama, I made it. These people just offered me X. But you might not call your tax advisor or your financial planner and say, hey, they just offered me, does this make sense? Is this in line? Can I structure this differently? You know, my tax situation and everything else that's going on. And I think that's the biggest thing, is just kind of, as you're putting together your team, knowing that anything that involves money, you need to involve your team too, which is a big deal.
Yep. Yeah. And because we talked about these equity compensation packages, it was heavily on the tax, the financial planning aspect. But as we were touching on earlier, Rosalind, like making sure you have that attorney. And if you do get a sizable equity compensation package, like I talked about, if you're an executive or somebody, that you're probably going to want to make sure you have a strategy in regard to gifting and making sure your estate is handled well as well. So having that attorney as part of your team is going to be really crucial.
That's a good point. I'm team estate planning. So I'm always like, if y'all ain't got y'all stuff together, I say it almost every week. Get you an attorney. Do not, no free, nothing. Spend a little. This is where you need to spend a little money.
Yes.
Spend a little money there. But like, what if you die and you have some existing options or restricted stock up there? What happens then?
Totally depends on the grant agreement, and it depends on how nice the company is, honestly. I know one client I work with, everything 100% goes to the spouse, which is a really, really nice, whether it's vested or unvested, which is crazy. Typically, if they're vested, they kind of just pass based on like beneficiaries or anything like that. But only for the vested or the exercise, excuse me. So for RSUs, vested, stock options for the exercised one. But for this company, they said anything vested, unvested, exercised, unexercised goes to your spouse. And I was like, wow, that is a nice package. That is a very nice package, because of course, if you're an executive or maybe you just got there and God forbid something happens to you, knowing that your partner or your family could still have that same decision is such a blessing. It's not common. It's actually one of the only companies I've seen that offered it. Um, but when you do exercise, it's important to make sure you're very clear that you're adding that in like the list of assets that you have as part of your estate, because it's something that also your family may not know to look for. And you don't want to leave that on the table as well, especially because you do own it once you exercise it. So just making sure you have that list of assets always updated. If you have a trust, make sure your titling is accurate. If you do plan to gift any shares or any equity in that regard, make sure it's listed very clearly so it's not left on the table. Because like I said, this is not, if it's held in places like Carta or all these other platforms that aren't like the traditional Fidelity or Schwab, your family won't know to look for it. And you just don't want to, you want to make sure that it's not left or missed out on.
I think that's a really good point. And I think that's something, I know we were talking in the group a little while ago. People were like, I'll never get married again, those kind of things. This might be the time to say, does it make sense? You know, you might be looking at your long-term partner and say, wait, you just got what? Let me read that.
Like, yeah.
Head to the courthouse, make sure I get whatever you might leave behind. So I think that's part of the bigger plan too, is to figure out how does that make sense and how does that feed into the bigger plan. And that's kind of part of having your team and having your team to be able to look out for you, because you might want to do whatever you want to do and you can protect as many assets as you want to, but don't leave money on the table if you can. That's a very big thing as well. Now, if some of the ladies are saying, hey, I'm dealing with this now, or I'm waiting on a new job offer, I'm interviewing at the moment, and they want to talk to you, they want to get some advice, they want somebody to read through this thing and see if I'm going to make $1 million or pennies.
Yep.
How do they reach out to you? How do they get in contact with you?
So they can find me first and foremost. I included my email down at the bottom. It's chelsea@networthzenith.com. Or you can go to our firm's website, which is zenithwealth.partners. On there, of course, you can see my about me. You can also see the rest of our team. Or you can join our community, which is Women with Equity, where we specifically host events in the New York City area about how to build wealth using equity strategies. Of course, talking about equity compensation planning, also talking about how to review your own company's stock from a fundamental or technical analysis. And then we also do fun happy hours as well. But of course, you can connect with me on either one, Women with Equity or zenithwealth.partners. And we can schedule an intro call and I can talk a little bit more about our services and see how we can help you with your decisions.
I love it. This was such a great conversation because we are not making pennies anymore. We are making real dollars. We are negotiating contracts. We are negotiating offers. We are getting and enjoying the fruits of our hard labor, and 100% we are seeing different types of compensation. So every one of the ladies here are going to be C-suite and above.
Exactly.
Like, hey, I'm going to fund my next venture based on the stock that I get from this company that I'm working at today.
Yes.
And so that means you're going to need somebody. You need somebody to read through, help you understand, see if that makes sense, see if you can change the numbers or the vesting and a number of those different things. So make sure that you reach out to Chelsea if she can be of assistance as you're evaluating, checking. You want to interview and say, hey, I want to lean on you and see if this makes sense for us to engage in a relationship, because that is what a financial planner is. It's your long-term partner. And so I want you all to make sure that you are investing the time to build the team that makes sense as you continue to grow and advance in your career. I want to thank you so much, Chelsea, for being here with us today. And I hope if y'all reach out and y'all get this big money, share with me. Y'all ain't gotta tell me exactly what you made, but share with me.
Exactly. That's all part of the sharing, right? And the learning, and that's how we all grow. And we get to the C-suite, right?
Exactly. So make sure if you haven't hit the subscribe button, you have hit the subscribe button, because every single Monday at 7 p.m. we are here sharing some knowledge. We have great professionals every single week to provide us great information the same way Chelsea just did today. I want to thank you for being with us. And until next Monday, have a great day.